1st, the 4th, the 5th, the 6th, and the 7th. Those first 5 days, COMEX market received, what did they receive? They received a total of 1,002,000 ounces of silver. That's a lot to be received into COMEX in the first 5 days. 1,721,192 ounces over those first 5 days withdrawn out of COMEX, leaving the vaults. 1,890,316 ounces. So in other words, you're seeing the price being held down for various reasons. Silver, the military-industrial complex; gold to support the illusion of the bond market and the strength of the Western system, the currencies. And now they're being exploited by not only players around the globe who are coordinated, motivated, sophisticated, and wealthy, but also players here in the United States. And we don't know who they are. So between the 1.89 million ounces that were delivered in the first 5 days and the $7 billion worth of gold, over 2 million ounces of gold in the first 3 days, you're talking $15 billion worth of gold and silver that left COMEX within the first week of the August contract. Now, we're almost to the end of the month, and those numbers are much higher. It's the commercial banks. There's about 8 Western banks that hold the largest concentrated short position in the history of the COMEX market on any commodity traded in things like silver. Silver is the primary one where you're seeing tremendous suppression. You also see it in platinum. These same 8 traders, their footprint is everywhere. And they suppress the price into COMEX. And you look at, for example, the AM fix and the PM fix in London, where the price gets smashed every single time that we see the fix, either AM or PM, or heading into New York. This is something that, I mean, we could spend an entire episode talking about the suppression, but I think that the real issue, if I had to guess, was that it's not really at the desire of these commercial traders to suppress the market. Commercial traders are happy making the profits. If I had to guess, I would say it is at the behest of the central banks who are telling the commercial banks by proxy to do just this. When you see naked shorting, for example, let's look at London as an example. London right now, the LBMA, the 140-year-old exchange, the oldest in the world, we'll focus on silver for a moment, has 155 million ounces of silver in the vaults. It's the lowest amount of silver they've ever had in the vault since they started keeping records. They call that the float. Now, the actual number of ounces in the vault is closer to 800 million.
Physical stocks tell a telling story. In London, LBMA free float silver, that is, silver available for immediate delivery, has dwindled to approximately 155 million ounces, while total holdings near 760 million ounces remain mostly tied up in ETFs and allocated holdings. This limited float, enough to cover just 6 weeks of global demand, confirms severe supply constraints in the physical market. Against this backdrop, silver lease rates have surged past 6%, signaling tightness, while physical deliveries on COMEX have surged to nearly 2 million ounces per day during peak periods, though still not sustained across every trading day.
But that 645 million ounce difference belongs to the ETFs primarily, like Bullion Vault and SLV. So this is silver that is already encumbered. The 155 million ounce float are the ounces that are backing the contracts in circulation. Now, they admit to trading somewhere in the neighborhood of 190 million ounces per day. So they're already trading more than the float every single day. But if you look at and speak with a man named David Jensen, who I would strongly suggest you have on your show, his reporting is fantastic. And he says that the banks, the bullion banks, they took a survey a few years ago, and they admitted to the fact that the numbers that we see are roughly 10 times understated, because they only post the final settlement numbers on the exchange. They don't post the number of trades that were used to get to the final settlement. And so they're trading upwards ends, by his estimation, of 1.9 billion ounces per day, every day, off of a 155 million ounce float. Now, what could possibly go wrong with that? And this is why, for a good portion of the year, the LBMA is what's called a T+1 exchange. T is the trade day plus 1 to settle. By the third day, the metal should be moving out of that account into yours or being shipped. They told the world, sorry, there's a shortage of manpower and trucks at the Bank of England, and so we're T+8 weeks right now. So in essence, it's as if they got caught with their pants down because we're seeing so much in the way of deliveries leaving London. By the same token, the gentleman who runs the Tokyo Metals Exchange, he used to be the head trader for ICBC for Japan, and in trading metals on their metals desk, and now he's running the market at the Japanese precious metals market, and he's the head guy there. And he says, just the other day, I forgot his name. If I went through my notes here, I could find it. But he says, there is no platinum, virtually none, local, meaning location, London and Zurich, yet the LBMA is trading as much as 3 million ounces per day of spot contracts, which are deliverable with nothing behind it. This is the kind of manipulation that we've seen over and over and over and over again. Now, in terms of gold, I would argue that it has been used, and it seems to be breaking with gold, but it has been used to suppress the illusion, or to support the illusion, rather, of a strong bond market, of a strong Western system.
Historically, fewer than 1% of precious metal futures contracts resulted in physical delivery. Today, that paradigm has shifted. The August COMEX gold contract saw 100% of its contracts stand for delivery, translating into roughly 2 million ounces, or about USD 7 billion worth. Meanwhile, silver deliveries have also spiked. In just the first 5 days of the August contract, over 1.72 million ounces were delivered, while 1.89 million ounces exited the vaults. These volumes point to a profound transformation. Market participants are demanding real metal, not paper.
And if you create an environment for many, many, many years where you suppress interest rates to create an illusion of reality, an illusion of wealth and of stability in the Western system, you have to step on gold and silver, which are the canaries in the gold mine, in the respect that there's a term in economics called Gibson's paradox, which speaks to the inverse relationship between real interest rates and gold. And so they've stepped on gold forever to support this illusion of a strength of a Western system, of a bond market, and of a currency system. This is a game that has been going on for a very, very long time, and who it really benefited were the central banks, so that no one would question the value of the dollars or the pounds or the euros that were being used all around the world. No one would question the stability and authenticity of a bond market that was being used to act as the skeletal system, if you will, around the globe of liquidity and of stability and of authenticity. All of this stuff, if you're going to suppress interest rates, which is really what this all boils down to create this illusion of wealth, as we've offshored all of our manufacturing across the globe, you have to step on gold. And this has been going on for a very, very long time. Now, what's happening is that you're beginning to see countries in the global south, like the BRICS, who have become sophisticated, motivated, coordinated, and wealthy, and they are exploiting the backdoor option that is found in all of these contracts, and that is to stand for delivery, which no one ever did.
What's driving this radical shift? One theory suggests these surges aren't purely commercial in origin, but emerge at the direction or under the influence of central banks. The goal to bolster financial stability and maintain illusions of robust bond markets, low interest rates, and stable currencies. Precious metals, often seen as canaries in the mine, are frequently suppressed to conceal underlying fragility, preserving confidence in Western financial systems and fiat reserves. It's a long-running balancing act. Suppress price signals in order to sustain broader macroeconomic narratives.
Majority of my career, nobody stood for delivery. Less than 1% stood for delivery. And so when you realize that, when you see no one standing for delivery all of these years, and now all of a sudden we're seeing massive deliveries off the LBMA and off of the COMEX to the point where, it's unlike anything I've seen in 36 years. It has become very obvious that the rest of the world understands this. Speaking of the BRICS, they've developed what's called the BRICS Grain Exchange, and it's just what it sounds like. It's a grain exchange for the folks in the BRICS nations. And the gentleman who's behind it said, we produce more grain and consume more grain than the folks in the West do, but yet we don't have any ability to control the price. That's controlled on COMEX. But with the development of this new system, this new BRICS grain exchange, that will change. In other words, they understand that this is happening with all commodities, not just precious metals, but this is also happening now in the United States. I'll give you an example. I have numbers here from the first 3 days of the August gold contract, which is all but over right now, and the numbers are far higher than what I'm going to tell you right now, but this will give you an understanding. On COMEX, for the first 3 days of the August gold contract, right, August 1st, 5th, and 6th, 20,126 contracts were posted. That means they're posting for settlement. Most of my career, I would tell you that less than 1% of contracts stood for delivery. They would either be cash settled or rolled over to the next month. Of the 20,126 gold contracts, which represent 100 ounces per contract, or 2,126,000 ounces of gold, roughly $7 billion worth.
Today, a growing resistance to the suppression narrative is emerging beyond the West. Institutions and sovereign actors across the global South and BRICS nations are engaging in coordinated physical deliveries. They're no longer content to roll over contracts, they're standing for delivery, asserting claims to real metal reserves. This pattern reflects the emergence of parallel systems like grain and commodity exchanges driven by BRICS participants that challenge the dominance of established Western trading structures. The result? A tectonic realignment of global commodity flows and monetary strategy.
100% of those 20,126 contracts stood for delivery. They weren't cash settled, they weren't rolled over. 100% of them did. That's $7 billion worth of gold that stood for delivery in the first 3 days of the August contract. This is the same thing that we've been seeing over and over and over again. Someone got into Trump's ear, if I had to guess, and told him that this was happening. And if we don't start standing for delivery, we're going to end up losing to the rest of the world who understands what's been going on, that the West has been suppressing the world's commodities for various reasons. With gold, it was, as I mentioned, to support the illusion of the strength of a bond market in the Western system. With silver, I would argue it's different. With silver, I would argue it's the military-industrial complex who needs copious amounts of silver to make high-tech weaponry. I have validated from a client of mine who 3 years ago at a conference in Vancouver said to me, "You're right," when I said that there's 500 ounces of silver in the tip of a typical cruise missile, a Tomahawk, a Patriot, Hellfire. They all have silver in the guidance system, between 13 and 14 kilograms. And it's not so much the price that worries the military-industrial complex as much as it is the rest of the world understanding that silver is not industrial, it is in fact strategic. In fact, I just saw this morning that the US government did something that I am very surprised by, something that is long overdue. And I could have sworn I saved it. Where did I put that? Have it. They reclassified it as, I want to call it strategic, but hang on a second. If I don't have it, I don't have it. I know I saw it this morning. Don't think I have it. I'll have to look for it. But the bottom line is, silver is, as far as I'm concerned, strategic. Now let's look at the silver numbers over the first 5 days of the August contract. Remember,
unlike gold, silver holds unique strategic importance, especially for the military-industrial complex. It's integral to modern weaponry and advanced electronics. Today's tight supply underlies both its industrial necessity and its undervalued status. Coincidentally, silver is also flying off exchange vaults at staggering rates, even as lease rates climb and inventory plummets. This convergence of industrial demand, strategic necessity, and constrained supply creates a combustible mix. If current trends continue, silver could break out of long-standing price constraints, forcing the market to reassess its value and importance.
No one ever stood for delivery with silver. But to my point about the military-industrial complex, that's BlackRock. Let's say they own all of the manufacturers that produce these high-tech weapons, right? The military manufacturers of high-tech weaponry. They're also the primary custodian, along with JP Morgan, of of SLV and GLD. SLV is the largest silver trust in the world. And so you think about it, they suppress silver to build high-tech weapons, so that, you know, if the price were to go higher, it would signal to the world that, hey, silver is more important than we are being led to believe, and maybe we should accumulate it. And so they hold down the price to keep it and make it very counterintuitive to keep it off the radar. Now, BlackRock builds the weapons. In essence, they own the companies that build the weapons. They need silver. Then they are sold all around the world to fund war. Places like the Ukraine and Syria get blown up, and then who gets the reconstruction contracts? That's right, it's BlackRock. And so this is a very insidious game, if you will, of holding down the world's commodities for various reasons. But over the first 5 days of the August contract, in fact, it was closed August 1st and 4th, so just the first really, well, actually it wasn't, I take that back. It was the 1st, the 4th, the 5th, the 6th, and the 7th. Those first 5 days, COMEX market received, what did they receive? They received a total of 1,002,000 ounces of silver. That's a lot to be received into COMEX in the first 5 days. 1,721,192 ounces over those first 5 days withdrawn out of COMEX, leaving the vaults. 1,890,316 ounces. So in other words, you're seeing the price being held down for various reasons. Silver, the military-industrial complex; gold to support the illusion of the bond market and the strength of the Western system, the currencies. And now they're being exploited by not only players around the globe who are coordinated, motivated, sophisticated, and wealthy, but also players here in the United States. And we don't know who they are. So between the 1.89 million ounces that were delivered in the first 5 days and the $7 billion worth of gold, over 2 million ounces of gold in the first 3 days, you're talking $15 billion worth of gold and silver that left COMEX within the first week of the August contract. Now, we're almost to the end of the month, and those numbers are much higher.